Welcome to our presentation. Our group chose the Santa Claus Rally as our topic for the stock project. My name is Jalen Cunningham, and I'm going to go ahead and kick things off. So the stock project is centered around the topic of efficient markets, and within efficient markets, we have this hypothesis that assets are equal to its intrinsic value, and that us as investors behave rationally. So when prices become too low, us as rational investors are going to go ahead and buy off a lot of stock, meaning that the price is going to go up. And then once the price becomes too high, us rational investors are going to go ahead and sell off a lot of stock, bringing the price back down to equilibrium. So within this, we have the behavioral finance field, and theorists within this field believe that real-world behavior clashes with this hypothesis, and that more often than not, investors are swayed by their emotions and their past experience. So this idea that psychology plays a part in our investing behavior leads us into our topic of the Santa Claus Rally. So the Santa Claus Rally is this overall increase in the stock market during the last week of December and the first couple of days of January, hence the name Santa Claus. And there are a lot of people who relate this rise to their bonuses. Holiday bonuses come around this time, so more often than not people invest when they have more money. But more often than not, the explanation for this rally is the overall emotional effects of this time of year. During the holidays, you are in better spirits, meaning that you're more likely to take risks, you're more than likely to invest. So this causes the overall rally in the stock market during this time. So based on the research that we've done, we found that it does hold. And I'm going to go ahead and pass it off to Isabella to discuss CAPM models and to discuss the research that we've done related to the Santa Claus rally.
Now I'm going to jump in and talk a little bit more about the capital asset pricing model and how it relates to our project. So the capital asset pricing model is a tool that's used to calculate an estimate of the required rate of return of a stock based off of risk. And if you look at the equation, you can see that the higher the risk is one of the only ways that you can get a higher rate of return, which is one of the basic assumptions of the model. One of the other basic assumptions of the model is that all stocks are properly priced, which is what Jalen was talking about when she was explaining efficient markets. So this model and the resulting estimate of the required rate of return functions assuming that markets are efficient. But as Jalen also explained, the Santa Claus rally shows that there are certain psychological and emotional factors that influence the market around this time of year, effectively making the market inefficient because prices are not properly priced. By doing so, this will impact the accuracy of a tool like the capital asset pricing model. Moving on to some of our own research about the Santa Claus rally, we looked at several studies. Some of the studies that we took inspiration from actually looked at the January effect, which is similar but not the same. But we looked at these anyway because they were more studied and there was a little bit more to learn from them. And some of the studies listed on the screen here, the Huang and Hershey study and the Foliot study, are looking at the January effect, not the Santa Claus rally. The Nipani, Washer, and Johnson study does look at the Santa Claus rally and was done in 2015. This study basically looked at indices from Christian and non-Christian countries in both the holiday and non-holiday seasons and compared them. And what they found was that there actually is statistical evidence to support the existence of the Santa Claus rally. So we basically sought out to recreate this study, and I'm going to pass it off to Hrishikesh, who's going to talk a little bit more about our own findings and methodology.
Thank you, Isabella, to talk through us about the CAPM and the research done in the Santa Claus rally. I'll be mainly talking about our methodology and the final observations that we concurred from the methodology. So basically, we studied 4 indices over the past 20 years, and we looked over the global market for the 4 major indices, and we took the USA index, the S&P 500, the Sensex in India, the FTSE in UK, on the HCI Hong Kong Stock Exchange in Hong Kong. And using these major indices, we divided them into the Christian-based countries and the non-Christian-based countries. Using the data collected, we analyzed the trades over the total period versus the holiday period, which is the rally days. And this is the data up to Jan 3rd, 2019. And the holiday period basically consists of the last several days in December and the first couple of days in January. And furthermore, we compared the mean, standard deviation, skewness, and kurtosis of the data using the Excel financial calculator. And we considered the daily closing prices of these indices with the past 20 years. After comparing the data and analyzing the trends, we put a map distribution comparing the rally periods over the total period. And this is the final observations that we could gather from all the trading days and rally days. As you can see, we've divided them into the trading days and rally days. And then there is a small distribution comparison of rally period versus the total period based upon the Christian-based countries and the non-Christian-based countries. Furthermore, you can see that the mean and the riskiness factor over the rally period is much more higher and better than over the normal trading days period, which basically justifies and proves the Santa Claus rally.